Hey guys, Zach Scheit here with the Rich Retirement Letter. And today I want to talk about two areas of the market that are actually showing a lot of strength despite the weakness that we're seeing in the broad market. We'll talk about one stock for each of those areas that you can buy right now. But first, let's take a look at what's causing some of this weakness in the market. There are kind of four areas that I've seen investors start to worry about. The first is the reopening trade. We're wondering, is that still in play? Or is the Delta variant and some other challenges causing some of these reopening stocks to not be as exciting as they might have been otherwise? The second is comparables or comps. We're heading into the earnings season for the third quarter, and after a year of really strong growth, we're now wondering whether companies are going to see that same level of growth and whether the market is priced too richly or priced appropriately for the level of growth that these companies and that our overall economy is going to keep having. The third area is interest rates. The Fed has kind of indicated they're going to stop their purchasing of bonds over the next year, year and a half. And at the same time, we're looking forward to seeing the Fed raise interest rates. Meanwhile, market interest rates, the rates that you get on a 10-year Treasury, 30-year Treasury, mortgage rates, those are starting to creep higher, and those are causing some concerns for the market and specifically for tech stocks. And then the other thing that is really interesting right now is that we have a lot of new investors that came on kind of in those Robinhood days of lockdown periods where there wasn't much to do, but people had money because of Fed stimulus or government stimulus. And so there were thousands and thousands of new accounts opened up and thousands of investors that made a lot of money as this bull market continued to move stocks higher. These guys haven't seen a bear market yet. And as markets start to trade lower and volatility comes back in, there's some panic starting to set in from these rookie investors, and it's important, especially if you are one of those investors, to understand how to sidestep some of this carnage and to look for areas of the market that are doing quite well. They say there's always a bull market somewhere, and that really is true. And today, we actually have two areas of the market that are doing well, that are making new 52-week highs, and that have lots of great stocks in them that you can invest right away. So let's take a look at those areas, and you may want to consider moving some of your money out of the speculative areas that are starting to see weakness and into some of these more solid plays that continue to drive profits. Now, the first area of strength that I want to talk about is financial stocks, and specifically bank stocks. Now, banks have historically made money by borrowing funds at a cheap rate and then lending them out to businesses and individuals at a more expensive rate. And the difference between those two is called net interest income, and that's where banks make money. Now, we want to look specifically at regional banks because these banks are the ones that actually still keep that same traditional business model. And as interest rates move higher, these regional banks are seeing their profits increase. Now, part of the reason that these businesses are increasing their profits is because the overall economy is reopening, and small, medium-sized businesses are starting to invest in new plants, in hiring new people, in opening new locations, and all of that requires capital, which they will borrow from the banks. So the banks are able to lend this money out to more and more businesses at a higher rate and actually lock in bigger profits. Now, I want to encourage you to look at the SPDR, the Spider S&P Regional Bank ETF, which is ticker KRE. That's a basket of lots of these different regional banks, and it's been doing quite well and ready to break to a new 52-week high. And then if you want one specific stock, I like Fifth Third Bank, which is ticker FITB. This is primarily a Midwest or Heartland America bank, but it's actually spreading into the Southeast, and it's a growing company. They're a great bank for small, medium-sized businesses. They've got an expanding footprint, and they pay a 2.5% dividend yield. So they're a great bank for you to invest in, and the stock has been trading higher. And I think it's got a lot farther to go as interest rates keep marching higher. We're still at the very early stage of rising interest rates for our US economy. Now, the second area that I want you to look at is the energy or the oil and gas area of the market. And oil and gas producers have a lot of room to run higher because of higher oil prices. Now, oil prices are going higher for two reasons. One is the demand side. We've got the overall economy reopening, we've got people back on the road, and there's just a lot more demand for gasoline and other fuels, which drives demand for oil higher. The second thing is the supply side, and for years, oil and gas companies have not invested in new projects the way that they would have in the past. Now, part of this is an environmental thing. Part of this is the fact that oil prices were just low, so there wasn't an incentive for them to do that. But at any rate, we now are in a place where we don't have enough supply coming online. Prices are higher, and so oil and gas companies have every incentive to try to drill as fast as they can and try to actually be able to pull more oil out of the ground to help meet this demand and to drive their own profits higher. One of the companies that's benefiting from this whole industry is Halliburton, ticker HAL. They're a name that we just added to our income on demand service, the service where we sell put contracts to generate income for stocks that we would like to own. And Halliburton actually serves this whole oil and gas industry by providing parts, expertise, services, and other things to oil and gas producing companies. Now, Halliburton is growing their profits. They're trading at just about 15 times next year's expected earnings, and they pay a 0.8% dividend yield. Now, that's a little bit low as far as the dividend yield is concerned, but this is after the company cut their dividend during the coronavirus crisis just to make sure that they had enough cash on hand. I expect that dividend to actually move back up because they're earning plenty of money to actually be able to pay a much higher dividend. And so if you buy Halliburton right now and the company raises its dividend, then you'll get more income, and I think the stock will move higher as that dividend is reinstated. So those are two names that I think you can profit from in this market, despite the overall market weakness, and still make money to help you grow and protect your wealth, even in a challenging market environment. I'm Zach Scheit from the Rich Retirement Letter. I hope that you'll give me some feedback. Send me an email at richretirementfeedback@stpaulresearch.com or tweet me at Zach Scheit, SCHEIDT. Thanks for watching, and I'll be back with you next time.